What's up, guys? Your agent Tyler Wehrung here, and today we're going to talk about how we can still use our home equity in this rising and even some would say high interest rate environment. So this is the middle of 2022, just for context, and just to set the stage, we just had the highest in terms of percentage interest rate hike in history. All right, now that sounds very newsworthy or kind of blood in the streets kind of language, but it's just to say, we're not at historic highs, but we've gone from such a low amount to such a high amount, or we've almost tripled the interest rate in just a matter of 5 to 6 months. So people are just very uncertain at the moment, and I'm getting a lot of questions about if the HELOC is still even relevant, or what are some other ways we can still use our home equity to take advantage of whatever life is throwing at us. So wanted to chat with you guys today about how you can still take advantage of your home equity to accomplish whatever goals you have, investment criteria, or just to consolidate debt. Those are kind of the general reasons why people reach out to me and ask questions about how they can use their home equity to help with that. All right, so before we get into the specifics, I'm going to cover something that many of you might be familiar with, but some of you aren't, and I get questions around this, and that is the like button still isn't hit. So if you could go ahead and do that for me, I'd appreciate it. But no, in all seriousness, the concept we're going to cover is called lien position. It sounds like it could be complex or one of these financial terms thrown out there, but it's actually very simple in nature, and you can almost think about it as a line position, or what position in line are these lenders going to be in if the unthinkable happens. All right, so to do that, I'm going to just quickly explain using this graphic here. So this is your home, obviously. Didn't graduate from art school, but so this is a home. This is kind of 100% of what your home is worth, and this first bar here is drawn at 80%. Not to scale, don't judge, but just to show this is typically where a bank is comfortable putting a first position lien on a home. And what that means is, if the worst case scenario happens and they have to come after you to kind of recover their investment, they're in the first position to do that. No one else is ahead of them, except for a fun fact: property taxes always jump the line. The property taxes will always be paid in a foreclosure situation, but after that, whoever's in first position gets whatever is left. All right, and so that becomes important when we start to talk about risk. So interest rates are a direct proportion of risk that a bank is willing to take. So this is why credit cards are in the 15 to 20% interest rate range, because they really don't have any collateral. They don't have a lien or anything to go after other than dinging your credit score. And while they may feel good about dinging your credit score and making your life miserable, that doesn't help them recoup any of the funds that they lent you that you didn't pay back. So they have to have a high interest rate to compensate for that higher risk that they're taking, and you're going to pay them accordingly. So when it comes to homes, this is why home investment is where you get your lowest interest rate on just about anything else, because the bank knows if you can't pay anything else, you're likely going to find the funds or scrounge up the funds to keep a roof over your family's head. That will probably be the last thing that you skip your payment on, and if you do so, worst case scenario for them, they get to go after the house, resell it, and recoup their funds in the first position. All right, so where that comes into play here, when we start to talk about home equity, most folks have, if you have any debt on your property, chances are you have a first position lien against your home. So whoever lent you that money, they actually recorded a lien with your county recorder's office that basically just puts the public on notice that, hey, I'm entitled to this amount of money and I will be paid first if something happens here. All right, so with that kind of stage set, let's start to talk about how the three options that we typically take advantage of home equity. So the first option being the home equity line of credit, the HELOC, which you should be very familiar with here if you follow this channel. If not, subscribe below. We talk about all things HELOC. The second thing is the home equity loan, and the third being the cash out refinance. Those are the three most common ways to tap into the equity in your home for, like I said, either to take advantage of an investment opportunity, to invest in real estate, or to consolidate debt, hopefully those are the two buckets, and it's not that you want to go buy a new car or a new boat. Those typically never end out well. All right, so let's talk about this back to the context of lien position. All right, so first I'm going to link to a video over here where I shot all about comparing the cash out refinance with the HELOC, and it covers it in much more detail. But the big thing I want you to take away here is when you do a cash out refinance, you typically want to be going from a higher interest rate in this first position and trading down for a lower interest rate in that first position. Because when you do a refinance at all, it basically crosses out this first position, pays that off, and gives you a brand new first position with a new lender or a new note. And like I said, that's best used to go from a high interest rate environment down to a low interest rate. So if you had a 5% and then we were in these historic lows a couple months ago, it would have been in your best interest, not financial advice, but to trade down for a 2% loan. And the reason I bring that up is now that we're in a rising interest rate environment, the cash out refinance is less appealing because you likely already have a lower interest rate than what is out there on the market today. So you'd be trading from a low interest rate to a high interest rate, which is not the scenario you want to be in. So with that being said, the cash out refinance is really off the table at this point. So that brings up the home equity line of credit and the home equity loan that are still viable options in really any environment. All right, but they both will be recording a second lien against your property, and this is where it all comes into play. Since you're not actually refinancing, you actually get to keep this first position that you have, and hopefully it's at a much lower interest rate than what the market is today. And since you won't be refinancing in either one of these scenarios, you get to keep this hopefully in the 2 to 3 range interest rate. You keep that locked in. We're not affecting that at all. So they'll actually be recording a second position lien for whatever amount of equity that you have in your home that the bank will let you tap into. They'll be recording this with the county recorder's office, and this will be at a brand new rate. So you keep the first one in place, and this is a brand new one. So that's the reason we really just don't want to impact that low interest rate there. And although the new one will be at prevailing rates and terms, which likely will be higher, chances are whether you are consolidating debt or you're investing in real estate or making another investment with these funds, you can typically beat that rate or do better than your current situation is. All right, so the first scenario, let's say you're consolidating credit card debt. You're likely paying anywhere from 10 to 15% APR on 5 or so cards, whatever you're paying. And let's say, prevailing market rates are 6% right now. You would be better off in theory to take one home equity loan out at 6% than rather than paying 5 or 6 different payments at 10 to 15%. You're basically saving yourself maybe upwards of 9-10% every month when you make that payment. So that's a scenario where you could do that. Really, when it comes down to the home equity line of credit versus the home equity loan, you want to think about the duration you plan to use these vehicles. If it's more than 12 to 18 months, I like to stay away from the HELOC. I like the HELOC for very short-term endeavors so you can get in and get out, because it is a variable interest rate and you are subject to every time the interest rate changes in the market. I shot another video I'll link to over here talking about what drives HELOC interest rates and all things encompassing that. But yeah, I like HELOCs for short-term endeavors. A home equity loan is better for kind of debt consolidation or something that you're willing to make the payment on long-term, because a home equity loan is fully amortizing. It does give you that benefit of principal pay down every month as well. So guys, I hope that helps to really understand what your options still are in this current market. Cash out refinance or any refinance is likely not a good idea right now unless you just already had a ridiculously high interest rate and maybe your credit's gotten better, and even at market rates you're doing better right now. That maybe still be an option, but take a look and do a deep dive on that. And then when it comes down to the home equity line of credit or the home equity loan, you really want to think about what you're taking that money out to do. If it's going to be longer than 12 to 24 months, 12 to 18, whatever month I said, you're basically short term, you want to look at HELOCs. Longer term, you want to consider a home equity loan. But guys, nothing we talked about here today was financial advice. Always talk to your CPA, tax professional, or financial advisor before making any one of these investment decisions. Or if you don't know any of those or don't have one, just talk to someone who really understands your full picture. It's impossible for me to give specific financial advice without understanding everything that impacts your life, but I always do enjoy responding to comments in general. If you want to throw out your general situation, I'd be happy to give you my thoughts on it. I do respond to every comment and put a lot of effort into actually thinking through a meaningful response there. All right, guys, so if you haven't already hit the like button or subscribe to the channel, I'd be forever grateful if you wouldn't mind doing that. But as always, guys, hope you got something of value out of this. If you did, share with a friend. With that, guys, I'm Tyler Wehrung, and we'll catch you next time.